First up, though, we're going to bring in PIMCO's Tony Crescenzi, talk about Jackson Hole today and, of course, what may come tomorrow. Tony, it's great to have you back. We actually spoke a few days ago going into the symposium, and I wonder, after Bullard and Harker and George and Bostic today, have they foamed the runway enough? Is the chair's job a little bit easier tomorrow?
Well, it should be. In this day and age, transparency is the name of the game at the Federal Reserve. There aren't as many secrets as there once were, and especially going back to the first time a Fed chair attended the Jackson Hole Symposium, Chair Volcker, in 1982. This is probably, you could probably deem this symposium this year Jackson hype, because the Federal Reserve has a very clear strategy in mind, which is to make it clear that it wants to move the policy up expeditiously to what it thinks is neutral, then probably into restrictive territory, and then hold it there. And so instead of the so-called stop-go policies of the 70s, which are widely viewed as a mistake, it will likely be stop and hold. And so a lot of the work is done. It's easy. There's an easy prescription, and again, probably a lot of hype. One final word, Carl. Just looking at the last decade, the S&P 500 has only moved about 0.2% on average on the day that the Fed chair spoke at these symposiums. And so there tends to be an extra amount of hype surrounding the day.
Oh, no, we like to build it up. There's no doubt about that, Tony. I was curious. Esther George today did say she would want to see at least 3 months of consistent data to look in terms of looking for relief from inflation. That was the first time I'd heard a hard number. But if we're really in for a Volcker-esque period, as you suggest, is 3 months even enough?
Well, George is probably suggesting, in terms of the downshift, from the large 75 basis point hikes that we've been seeing to 50, then ultimately 25, and then to 0. It doesn't necessarily mean that the Federal Reserve will be lowering its policy rate. The Fed is pushing back on that idea. In fact, if the Fed does follow through with what its plan is, and the only plan we have is what's in the summary of economic projections, a 3.8% policy rate, that's a level that would be above what the Fed expects on inflation, about 2.5% or so next year. That would provide a positive real interest rate. So the lesson of history from the Volcker period, we're not talking about the same yields, of course, the levels of rates, but in terms of the thematic, which is to move the policy rate up enough, and then as the inflation rate comes down, let the real interest rate, which is the difference between the policy rate and inflation, let that move up, hold it there a while to ensure that inflation expectations are tamped down, and 1 quarter won't do it. It will take several quarters or more. The idea of faster inflation is embedded in many generations now. It's not just the boomers, as I said in our last discussion. Many generations believe in the idea of faster inflation and will want to be convinced in a few months. Absolutely, just from a human behavioral standpoint, won't do it.